Hello students, for today's video clip, we are going to practice how to calculate how to value a bond price. So we've learned in the class discussion, the sum of the present value of all the future cash flows discounted by the market rate is the bond value. So let's start the discount bond. What is the discount bond? Discount bond is when the investor's required rate of return or the market rate of return or the discount rate is greater than the coupon rate provided by the bond issuer. So what is the price of a 3-year bond if the investor required rate of return is 10% and the coupon rate 5% with $1,000 face value? This is the case of discount bond. Then we have to first measure this future cash flows provided by this discount bond. So how do you get the future cash flow? Every year, 5% times 1,000. This $50 is the future cash flows, right? By the coupon payment. Then at the end of the year, not just $50 of a coupon, but also $1,000, the face value should be returned. This $50, and $1,050 at the year end 3 should be discounted by the market rate or required rate of return from the investors. Why? That is the 10%. 5% is to calculate the coupon, but the 10% is actual compensation interest rate required by the investors. So it should be discounted. How? This $50 divided by 1 plus 10% is the required rate of return. Then to the power of 1, right? So that we got the present value of future cash flow year 1 is $45. We will learn the concept of this present value of the future cash flows. In the same way, this $50 in 2 years is not the same value at the current time. It should be lower, right? And then this amount should be discounted by 1 plus 10% to the power of 2, year 2. So the present value, the future $50 in year 2 at the current time is the $41. How about this value? 1,050 divided by 1 plus 10%, now to the power of 3, year 3. So we got the present value of the future cash flow 788. Okay, then we just sum this all the present values of the future cash flows. So we got 875. That is the present value. That is the present value of the bond. Okay, let me explain what that means. $875 present value, which is lower than $1,000 face value. That's why we say this is discount bond. If you are investor of this bond, you pay $875 today, but you will receive $1,000 at the end of this maturity year 3. But you will receive only $50, which is 5% interest every year, even though your required rate of return is 10%. But don't worry, because you will receive $1,000, which is the face value of this bond. Because $1,000 face value is already made, already fixed when the bond issuers sell this bond to investors. Oh, we'll pay back to you $1,000 regardless of how much price you paid today. That's why we say this is face value, never change. Again, you want to receive 10% interest every year. Anyway, in order to satisfy the investors, these issuers should pay 10% interest throughout the year, every year, 10%. Then how? The difference between $1,000 face value and 875. You purchase 875 discounted price, but you receive 1,000. But you receive only 5% of the coupon. Then let's identify. The coupon rate is again the 5%. That is the 5%. This fixed when this bond issued. And then L to maturity, which is required rate of return. If you hold this bond until the maturity, what would be the annual rate of return? That is the 10%. Exactly same concept as the required rate of return as 10%, or discount rate or interest rate by the investors. So all are the same rate of return, but the different expressions are based on the different purposes of using this the rate. Now, the current yield, how do you calculate current yield? Current yield is the income coupon gain based on the bond price purchased today. So this $50 every year, this is fixed coupon, the amount divided by how much is the present value of bond. Okay, so 5.71%. Then how do you get the investment yield? Investment yield, the YTM, the required rate of return, is equal to current yield plus investment yield. All the rate of return is comprised of the coupon, the income gain, the fixed income gain plus the investment gain, which is the difference between the purchase price and the selling price. You want to get the higher selling price than the purchase price, then you will get the investment yield positive. But if you purchase the higher price than the selling price, then you will receive the negative income, the investment yield. But in this case, how to get it? Right, there we go. Investment yield is equal to now the YTM that we already have, 10% minus current yield. Why? Again, the YTM is comprised of current yield plus investment yield. So this 5.71% is current yield. And then investment yield, the reason why we have the investment yield, annual investment yield 4.29% is that the difference between this, the present value of bond and $1,000 face value. Okay. Then let's compare this discount bond with the premium bond. Premium bond is the bond which the investors required rate of return is greater than the coupon rate. The lower than the coupon rate. So in this case, what is the price of the 3-year bond if investors required rate of return is 10% and the coupon rate is 15% with $1,000 face value? Okay, so how do we get the coupon price, coupon amount? Now the 15% now times $1,000 face value, right? So we got $150 every year, plus at the end of maturity, you receive as an investor this $1,000. So at the end of the year, future cash flow is $1,150, right? So comparing this discount bond, the same investors required rate of return, but the coupon rate is 15% and not 5%. So let's put 150%. In the same way, we discounted this amount by 1 plus 10%, which is market rate or the required rate of return or discount rate. In this case, we use this 10% for the concept of the discount rate, for the usage of discount rate. Then we got 136 because the $150 in a year is not the same value today. It should be lower so that we get the interest, the difference between two, right? And then also 150 divided by 1 plus 10% to the power of 2. In the same way, there's $1,000 150 should be discounted by 1 plus 10% to the power of 3. To the power of 3. So we got the present value of this all the future cash flows, 1,124. What does that mean? This present value of bond is now the premium bond, which is greater than the face value. You purchase the premium price with the premium higher than this $1,000. Why? You purchased at an expensive price than this face value that you are going to receive with, right? At the end of the maturity. So you lose some investment gain, but don't worry. Anyway, you will get this 10% your required rate of return. Why? Because you receive 15% coupon rate with this $150 every year, which is higher than this required rate of return 10%. Even though you require 10%, you receive the 5% more every year, right? But you receive only $1,000 face value at the end of maturity, even though you purchased at 1,124. You don't receive $1,124 because you received more coupon than your requirement. Okay, so always the standard rate, the market rate is the required rate of return. Okay, and the bond issuers should satisfy these other investors with this the required rate of return or the market rate or the discount rate. Okay, then let's identify all the bond rates. Coupon rate is already given 15%, and then L to maturity. Again, what is L to maturity? Required rate of return until the maturity, or the interest rate if these investors hold this bond until the maturity. What is the annual rate of return, right? That is the yield to maturity. Yield to maturity, so it is the same as 10%. And then current yield is 150 divided by, if I invest this bond at 1,124, and then I will receive in a year $150. So this is the current yield, 13%. And then investment yield, how to get it? Once again, this yield to maturity minus now the current yield, which is higher than the yield to maturity. Okay, investment yield is yield to maturity minus current yield. How to get it? Yield to maturity is comprised of the current yield plus investment yield, always comprised of the fixed income gain and the investment gain, right? But why do we have this negative investment yield, right? Because we purchased at a higher price than the face value of $1,000. 1,124. We purchased way higher price than this face value that we'll receive in 3 years. That's why it is minus. But this current yield based on this coupon payment we receive higher, right? Okay, so the yield to maturity is 10%. That is comprised of this current yield and investment yield. Okay. Then finally, this par value bond is very easy. When the required rate of return is 10%, the coupon rate is 10%, which is the same. The market perspective and the investors, the issuers' suggestions are the same. So here, 10% times $1,000, then same. And then we'll receive $1,000 at the end of the year. 3. Then present value of cash flows is calculated the same way. 10% discount rate, not the coupon rate, but the same rate as the coupon rate here in this case. Then the same way. Oh, but I have to put here. Sorry, this and then that. Okay, 11. Okay, then last one. 1 plus 10% to the power of year 3. So what would be the present value of a bond? As you expected, right? The sum of these three numbers should be $1,000. Why? 10% increased by the coupon interest. Then you discount by the same percentage. So we got the same present value. You purchase $1,000, you receive $1,000, but you receive $100 every year by the coupon payment. So the coupon rate at 10% and then yield to maturity is the 10% current yield, $100 divided by coupon amount divided by the present value today. So how to get the investment gain? There's no investment gain. Why? Because current yield, which is coupon yield, is the same as the yield to maturity. So you don't have any investment yield. You purchase $1,000, you receive $1,000 in 3 years, but you receive a 10% coupon every year by $100 coupon payment. Okay. Okay, this is the bond valuation process. See you guys in the next video clip. Bye bye.